Welcome back to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're in the home stretch of our live coverage of Inside ETFs in Hollywood, Florida. Joining me now is Bill Belden. He's the head of ETF business development over at Guggenheim. And we're going to discuss getting bond-like exposure through ETFs, which has been one of the key themes at the conference. Bill, thanks so much for joining us today. And really, that's the question, even though bond exposure is a necessary part of the portfolio, does it present challenges for investors?
Yeah, it sure does. And great to be with you, Jill, here at the conference. Certainly accessing the bond market can be very challenging. These days, with bond inventories being as low as they are, just finding bonds can be a challenge, or putting the work into finding bonds can be a challenge. And then you layer on the costs associated with transacting in individual securities can really make that a pretty costly proposition. And in today's low interest rate environment, every basis point counts. And so if you look at the value proposition of using ETFs to get bond exposure, there's a lot there to be taken advantage of.
How can investors use ETFs to get that exposure?
Well, one of the ways that we at Guggenheim like to provide that is through defined maturity ETFs. And so a defined maturity ETF, it carries a lot of bond characteristics. Most namely, it actually has a finite life or a maturity date on it. So one of the most appealing attributes of a bond is you get principal back at the end of at the maturity. And similarly, for bullet shares ETFs, and we have bullet shares ranging from 2018 to 2027, there's a maturity date at the end of each one of those products too. So that finite life is really helpful, particularly as rates are rising, because it helps mitigate interest rate risk.
Right, that's what I was going to ask you. What happens when interest rates do rise? How does it impact the ETF?
Well, you know, they're great for bond laddering. So that's a particular strategy that implementing bullet shares or defined maturity ETF are really good for. And so if you have a bond ladder, which means you're allocating your portfolio across a number of different maturities over time. As those maturities come due, you take those proceeds and you redeploy them in the next later dated maturity that you have. And so if you own a bullet shares ETF, like a bond until maturity, movements in the price as rates change do not impact what your experience is over time. So your ability to hold that product until maturity really helps reduce that interest rate risk. And in laddering, you're taking those proceeds and redeploying them into higher yielding bonds or funds at the end of the maturity spectrum too. So you do take advantage of a rising rate environment.
Tell us about the Guggenheim laddering tool.
Yeah, so we have a laddering tool on our website, and we really felt like the conversations that we were having with advisors about what a ladder looks like really need to ask for a visual to basically say, if I do a ladder, say 3, 5, 7, or 10-year ladder, I mix up the credit quality, for example, this is exactly what it looks like. Now, does what that output as shown, does that meet my objectives? And to the extent it doesn't, you can go in and you can toggle or change the variables that go into it to really produce a portfolio or an allocation that is aligned with what your needs are. So that output, which has client-approved material, can be very effective in communicating with clients.
All right. Well, thank you very much for joining us Inside ETFs, and we'll see you back in New York.
Sounds good.
And traders, thank you for spending the day with me. I'm Jill Malandrino, global